Investors this morning hope for a rebound in U.S. stocks after another day of big losses. All three major indexes were hit hard. The Dow Jones Industrials fell 459 points yesterday. That's almost 2%. That followed new Chinese tariffs on more than 100 U.S. products and President Trump's criticism of tech giant Amazon. William Cohan is a Vanity Fair special correspondent and author of Why Wall Street Matters, and he is joining us now to go through all of this. Great to have you on set.
Great to be here.
This is the worst start to the second quarter since the Great Depression. How much of this is driven by the president's comments or actions, be that on trade tariffs with China or going after Amazon directly?
Look, there's a confluence of events of which the president's commentary and tweets and policies, whether it's related to self-inflicted wounds, related to steel tariffs and aluminum tariffs, that come together. I mean, there's Fed deciding it's going to increase interest rates after close to 10 years of a zero interest rate policy. Investors don't like that. As much as they can anticipate that, they don't like that. Last year, the market went up, 35, 40% in anticipation of a big tax changes to the tax bill and a tax law that has now happened, and people are trying to digest it and figure it out. Then there are the self-inflicted wounds, whether it's the tweeting about Amazon or trying to break up various media mergers that don't have a particular logic. Why go after the AT&T Time Warner deal because you don't like CNN? Why not go after the Disney Fox deal, but you don't do that because you like Rupert Murdoch? Why attack Amazon on Twitter because you don't like the Washington Post that Jeff Bezos happens to already own as well? So there's a confluence of events. Nobody rings a bell at the top of the market and says, we're at the top, it's going to be down from here. But in my view, sort of like Warren Buffett, this is a healthy market correction. If you're long-term bullish on America and America in industry, as you should be, because that's proven to be the case over generations, then you should, as the intro said, everybody should just calm down and you view this as a buying opportunity.
So these fibrillations in the market, you say it's a healthy correction.
Absolutely.
That would suggest that it's based on the actual progress of the economy, real things, as opposed to tweets, which we're all learning whether to take those seriously or not as they affect actual policy. So how do you pull those two apart? What's real and what's...
Well, unfortunately, there's a confluence, right? Yeah. Some of it relates to the real economy, like if you raise interest rates, which is the Fed's duty to sort of take the punch bowl away just as the party is getting started, which they're now committed to doing, then that means that the money is going to cost more and it's not going to be quite as available. But we're not talking about big moves. We're talking about after zero interest rate policy for 10 years, we're talking about, 75 basis points. It's not, that's not a lot. But we have a high beta president who cannot be predicted.
High beta.
Diplomatically. And you can't predict what he's going to do. Self-inflicted wounds on tariffs, which causes China to put tariffs on our goods. Investors don't like that. CEOs don't like that. What's he doing with antitrust policy? CEOs don't like that. They can't figure out the rhyme or reason. So people get nervous. And by the way, it's kind of healthy to have this correction. Stocks got really crazy last year.
What would happen if Jeff Bezos buys Twitter?
I think a great idea, and shut down either the whole company or some certain accounts.
I saw that online today.
But wait, not if all this is healthy.
Yeah, I thought that was...
Right, well, that would be healthy, too. That would be fun. A nice counterterrorism.
Bill, always good to have you at the table.
Nice to see you.